So real estate math is a handout, 4-page handout that you should have. Um, at the very top, it'll say real estate math, and below it, you'll see conversions. And this is the kind of the basic intro to math. It's like Math 101. And I like to start out very delicate and then work my way into this. And that's my approach even when we get to the story problems. You'll see that as well. I like to take it from a very simple approach and then work into it from there. So if you are advanced, you may have some frustrations with the simplicity at the beginning. But for the sake of everybody, regardless of your level, hopefully by starting out here, we can get everybody acclimated at the same level. Now, before I get into all the math, when we're looking at the math for the real estate exam, about 10 to 12% of the exam is going to be math. The majority of the math is going to be on cap rates, and we'll talk about cap rates in a later chapter. But they're still going to use this one formula, this formula that I'm going to show here in a little bit. So not a lot of the test is math. In fact, you can completely bomb the math, and you can still pass your state and national exam. Another benefit with math is that when it's in multiple choice format, you have A, B, C, and D. So you have 4 answers, and one of them is correct. And so you can work the answers back into the problem if you get stuck. And you probably can finish about a third to maybe half of the math that way, just by working the answer back into the problem, and you wouldn't have to really know the system and how to do it. When we get into these settlement statements, and then I guess I could say the bulk of this math as well, if I had a class of 15 people, I would, on average, if I looked at my past classes or classes before that, statistically, about 4 to 5 of those 15 students would just get a hold of the math. It would come more natural to them, and they wouldn't have any difficulty passing or getting through these settlement statements in this math. It would click. About another 4 to 5, probably halfway through or closer to the end, we would have them getting on board with the first 5 as well. They would take some time, but gradually they'd gain some ground and they'd be able to grasp the math concepts. Maybe not 100%, but 98%. They'd pretty much get most of it. Then the other 5, or third, the last group may get some of it, but they'll never get all of it. And that's just how math works. Not all of us, our minds work that way. Doesn't mean that a person's dumb. They just aren't geared that way. They excel in other areas. So math can be a little bit of a tricky concept sometimes to grasp. If you don't like math, that's also going to affect how much you get, your attitude. If you have math anxiety, or you hate math, or you fear math, it's going to affect how you grasp the concepts as well. But again, by taking it simple, hopefully I can get more and more people on board with understanding these concepts. So to start off with, we're going to do some very basic conversions. You'll see there at the top of this real estate math handout. And so if we're going to convert a fraction into a decimal number, we're going to divide the top number by the bottom number. So if you look at your handout, you'll see the first one underneath examples is 1/4. So if we want to convert that into a decimal, or a number we can use on our calculators, we'll take the 1, hit the divide sign, then hit 4, and we should get 0.25. For 1/2, 1 divided by 2, we should get 0.5. For 1/3, 1 divided by 3, we would get 0.33. And for 1/8, 1 divided by 8, it's 0.125. that's a great point. You may get 1 or 0.13 because your calculator automatically rounds up. Now on the calculators that we have here and other calculators like it, there's a way to add more zeros after the decimal. So the ones here, if you hit Shift 4, so there's a green Shift key. If you press that key, then hit the number 4, you'll have several more zeros populate after the decimal. And then now if you take the 1 divided by 8, you'll get 0.25 or 0.125. So if you press the green Shift key and then the number 4, that's all you'd have to press. You'll get the 4 zeros after the decimal. And that'll stay that way for the rest of the time you use the calculator until you shut it off. When you shut it off and turn it back on, you're going to have to push the Shift 4. Or you can press Shift 2 if you want to go back. But when we do these calculations on the settlement statements, you're going to find that the answers may be a little bit off by just a few cents. We just saw on the 1/8 that it rounded up. So if you have your calculator set at the Shift 4, you're going to get a different answer than the traditional calculator will. These conversions you won't see on an exam. I mean, the sample questions that are coming up here in a little bit is what you're going to see on an exam. So to convert percentages into decimals, we move the decimal point 2 places to the left and we eliminate the percent sign. And all we're doing is we're just trying to create a number that I can use in my calculator. Okay? The calculators here, you actually have a percent sign that you could punch in after the number. So for instance, on the first one, we have 67.49%. You could just do 67.49 and then hit the percent sign on the calculator and then continue out with the rest of the story problem and you'll get the right answer. If you don't have that function or feature on a calculator, you're going to need to be able to convert it into a number you can use. And so 67.49, we're going to move the decimal point 2 places to the left. So that would give us 0.6749. 4.85%, if we're going to convert that number, we would get what? 0.0485. And that's one of the most common mistakes. You're going to find not only in the math, but also in the other multiple choice questions that you're going to make, or there's a tendency to make, hopefully you don't, but about a third, maybe 40% of the questions, if you would have slowed down and taken some more time, you would have gotten them right. And that's a substantial number if you're looking at a 74%, which is failing, versus an 82%, which is passing. So it's much better to take your time, and when it comes to the math, that 0.0 or adding the 0 in front of the 4 is one of the more common mistakes that are made. So it's 0.0485. And the last one you'll see is 96.5. And the reason why there's that first blank is because we're going to convert the half into a number or a decimal. We take the 1 divided by 2 and we get 0.5. So it's 96.5. And then now we're going to move the decimal point 2 places to the left. So we convert that fraction or that percent into a number we can use on our calculator. So 96.5 is 0.965. Next, we convert decimals into percentages. We're going to move the decimal point 2 places to the right and insert a percent sign. So we really won't be using this in our calculations, but when we're now putting it on paper or finding our answer, we're going to have, let's say, the first one, 0.7. If I'm going to convert that into a percent, if that's actually should be represented as a percent, we're going to take that decimal, move it 2 places to the right, and so our percent will be 70%. Very good. .04, moving that 2 places to the right, we get 4%. And then finally, 0.895, moving that 2 places to the right, we get 89.5 or 89.5%. Next one, this one's a good little trick to learn. If you're asked to find the percentage of a number, the word of, in italics there, means that we should multiply. So for example, on number 1, or below example number 1, we see 8% of 193,000 means we take 193,000 times 8%, or of course you could flip that and say 8% times 193,000. We would get what? $15,440. Perfect. 7.5% of 85,000 means 85,000 times 7.5. And now there's an extra blank there because, again, just like my 96.5 that we looked at above, I'm converting that half into a number. So 1 divided by 2 gives us 0.5. So it'll be 7.5. That's what would go in that first blank. So I take 85,000 times 7.5, and I get what number? Or 7.5%. $6,375. Now, again, with the calculators that we use here, or maybe the calculator that you have, if you have the percent sign, you can simply take 85,000 times 7.5, then hit the percent sign, and then hit equals, because it's 7.5%, and then you'll get 6,375. That way you wouldn't have to convert it to 0.075, so you'd have a number that you can use on the calculator. So below those 2 examples, we see commissions or brokerage fees. A brokerage fee or sales commission, they can use either word on the exam, is always based on the sales price of the property. Cooperating brokers are paid a portion of the total brokerage fee or the commission, and the broker associate, which is what we call ourselves here in South Dakota, or for your exam, a lot of times they call them a salesperson. They earn a portion of the firm's earnings, and we did a flow chart in Chapter 7, so you can see how the seller pays the commission and how it works its way down into our pocket, whether we're representing the seller or buyer. Calculating the sales commission, at the bottom of this first page, Larson agreed to pay a 5% commission on the home that she listed with Best Realty. The house was listed for $120,000 and sold for $115,000. How much was the total commission? So what do we get? $5,750. If you didn't get that number, chances are you took the list price, which was $120,000, instead of the sales price, which is $115,000, times the 5%. Page 2 at the top, we see calculating cooperating brokers' fees. There's 3 questions there. And then in the middle of the page, you'll see calculating the sales price from the commission. So what I want you to do is work those first 3 at the top, and then stop there in the middle. We'll go over those 3, and then I'm going to introduce a new formula to you for the rest of this page, and that primarily is going to help you with the rest of today, the rest of or Chapter 17, for instance, when we look at the cap rates and things like that, and then also your exam. problem number 2 at the top of the page, calculating cooperating brokers fees. Sales price of a property is $164,000. The commission is 6%, with 3% going to the selling firm and 3% going to the listing firm. How much does the listing firm receive? $4,920. So we had $164,000. What was the commission? 6%. We take it times 6%. We get 9,840. And we can just take that, divide it by 2, and that'll give us the 4,920. That's maybe a little bit drawn out, because there is a shorter way or one-step way to do that, which would be what? There you go. Just taking 164,000 times 3%, you'd get the same answer. And that's what you'll find with these math problems. The way I may calculate it out on the board is different from the way you did. As long as we both got the right answers, that's what's important. So now number 3, the listing commission or firm has a 50-50 split with their agent. How much does the agent receive? So we take the 4,920 and we just divide it by 2. So your commission on that sale was $2,460. Number 4, you'll see that we had a property manager receiving 70% of the first month rent as her commission on the property that she's renting out or managing, plus 6.5% of rent for all the remaining months. How much commission will she earn on a 3-year lease with rent at $2,500 per month? So before we start the middle of the page, or question number 5, I want to introduce this ERV formula. Call it ERV because we have the I, the R, and the V. So ERV. With this ERV formula, when you have a problem, story problem that has a percent sign in it, or it's looking for an answer with the percent sign, chances are you can use this ERV formula. So the I on the top, as you'll see defined below, is the income or interest. And it's always going to be in the form of an annual number. So if you're figuring out interest that's there on a loan, and you're going to put in your numbers, when you come up with the I, it's going to be an annual number. So if they ask for the monthly interest, you're going to have to divide it by 12. The R is the rate, and that's always signified by the percent. So if we're looking at cap rates, or if we're looking at like the commission, like commission is 6%, or the rate on a loan or interest rate, which maybe is 3.65, then that's going to go right here in the bottom left. The V is the value. That goes in the bottom right. That's going to be like your purchase price. It could be the loan amount. You just have to read the problem. And so like on these first few, you're going to get 2 different numbers that you can put into the ERV formula, and then you'll be missing the 1. And once you put your numbers in, then it's just multiplying or dividing, and you'll get your answer. And you'll see how that works as we go through these problems. Sometimes, actually, most of the time, this I and this V are not called income or value or interest or value. It's going to be things like a purchase price. It could be a commission. So it could be other things that are not necessarily starting with an I or a V. And so you may wonder, well, it doesn't clearly say I or V in the item. So where does it go, on top or bottom? Well, this is why I have this up here, is because we're going to put the little number on top and our big number on the bottom. And you'll see how this plays out more when we start going through these story problems. And you can't use the ERV formula for every question. So I don't want to say this is the ironclad rule across the board, because then you're going to find yourself getting some wrong answers. But most of the time, especially when we're dealing with cap rates, this is how it goes. We have the R on the bottom, the V, and then the I on top. So once you get your numbers in, and we'll go through this too when we go through these next exercises. Once we get our numbers in, we're going to have to know whether we divide or multiply. If I have, from the story problem, I've been given the I have been given the R, the rate, but I'm missing the V. That's my number I need to figure out. Not sure what that is. If I'm going from top to bottom then, to figure out this number, I'm going to divide. Or I could say it if I have the I and the V, but I'm missing the R, so I have the top one and the bottom one, I'm going to divide. Either way, if I'm going from top to bottom, I need to divide. And how I do that is I'll take this number I have, I'll press the divide sign on my calculator, and then it will give me the V when I hit equals. So let's say this is 75,000 and this is 1.2 million. I'd put in 75,000, I'd hit the divide sign, I'd press that button on my calculator, then I'd put in the 1.2 million, hit equals, and that'll give me this number right here. Let's say I have the bottom two, but I'm missing the top. Okay? So I have the percent and the value, or the rate and the value, but I don't know my income. If that's the case, then I'm going to multiply. I'm going to take the R times the V, or of course you could flip-flop that. I could take the V times the R. Either way, I'm still going to get my top number. And remember that when I get that number, it's always going to be in the form of an annual number. So if they're asking for monthly or quarterly, I'm going to have to divide accordingly. This will begin to make more sense, of course, when we start getting into these formulas. So let's look at number 5, or the middle question on that second page of the handout for real estate math. It says calculating sales price from the commission. So we can do the first one together, and I'll let you do the remaining two on the bottom on your own. So if a seller paid 8% commission, which totaled $7,560, what was the actual sales price of the house? So we're going to use the formula for this problem, but you don't have to. There's other ways, that's one of the beauties of math, that you can come up with the right answer. And again, I don't care what avenue you take, just so you get the right answer and pass the exam. So the commission, which is in the form of a percent, we know is going to go in the bottom left, 8%. Then we have one other number. It is $7,560. I don't know if this is the I or if it's a V, because it says that it is the commission. That's the commission that the realtor made or the brokerage firm made on the sale of the house, or the commission that was paid out. The final question, though, is what is the purchase price? What was the original purchase price? And there again, I could determine that purchase price is the V, because I've said that already. So then I could automatically assume that this is the one I don't know, the bottom right, and then put my commission up top. But if I didn't, I could also ask myself this question: out of those two numbers, the purchase price or the commission of $7,560, which one's going to be bigger? The purchase price. Purchase price is bigger, and the big number goes on the bottom. So big number on bottom, I don't know what that is, but my $7,560 up top. Since I have my top two, or my top number and my bottom number, I'm going from top to bottom, I divide. So I take 7,560, I press the divide sign on my calculator, then I put in 8%, I hit equals, and I get what number? Perfect. 94,500. You can use this formula for the next two problems, and then we'll go over them together. So number 6, a 6% commission of $7,000 was earned on a sale, and the house sold for 97% of the list price. What was the original listing price? Perfect, $120,274. So we can use this formula actually twice to come up with that answer. So first off, we know the commission is 6%, and what was earned is $7,000. We don't know what the purchase price is. So we can put the 6% up here, $7,000 above it, and remember, if we're going from top to bottom, we divide. And when you divided those, what did you get? $116,666. And this represents 97%. They want to know what the actual listing price was. So if I put my 97% here, 116,000 here again, and I'll divide because I'm going from top to bottom. I'll get the 120,274. Number 7. What was the list price on a home that a broker earned 7% commission of $5,492 and the home sold for 95% of asking price? So really, we're going to work it out the same way. So the commission was $5,492. Is that right? Okay. So I'm going from top to bottom. When I divide that by 7%, what do I get? And then when I take that number and divide by 97%, and there's some change on the end of that. Sometimes the questions have it. Sometimes the answers will be $82,586.47. Sometimes they just leave off the change. Either way, whether or not you have the extra decimals at the end or not, like we talked about earlier, you'll still see the answer in A, B, C, or D. Top of page 3, you'll see the word prorations. Certain costs, such as utilities and taxes, are prorated, or they're divided between the buyer and seller the day of closing. For this exercise in your test, there's 30 days in a month and 360 days in a year. Before we start, let's recap the basics in the real estate supplement guide. And so that's on page, or in chapter 2. Is that right? Chapter 2. So let's look at that. So chapter 2, the licensee must possess the necessary knowledge to prepare the closing statement and give the seller an accurate estimate of their closing costs, and also let the buyer know what the amount of money they should need if they have to bring any money in at closing. And that's typically how you're going to see the scenarios played out in the book, and even for your exams, is where the seller is getting money at closing and the buyer is bringing in money at closing. The nice thing in the real world is that this is done for us through the title company. If you skip on down a few paragraphs, you'll see on that first page that the buyer will need to know how much money they will need at the closing in cash. It's about the fourth paragraph down. To determine that amount, the buyer's debits are added together. It gives us some examples of what those debits include. Then the buyer's credits are added together. And then we subtract the credits from the total amount of debits, and that new number will tell us how much the buyer needs to bring at closing. It says finally that the buyer needs to bring a certified check or cashier's check to the closing, no personal checks. That's a little bit more for the real world. Highly doubtful you'll see that as a test question. Bottom paragraph says that the seller's process is going to be very similar to this. The seller's credits will be added together. That includes things like the purchase price, any prepaid items from the seller. The seller's debits will be added together, including their expenses, like prorated items to be paid later by the buyer and any loan balance. The next step is to total all of these credits together and subtract all of the debits and calculate the balance due to the buyer. So let's take a look at an example to the seller. Thank you. Let's take a look at an example. If you turn to the very first closing statement problem, 102-1, on page 26 in your book, you'll see to the right of that, or the following page at the top, says Settlement Statement Worksheet. And this is a blank worksheet. This is what you'll use to complete settlement or closing statement problem 102-1. And if we take a look at the worksheet, we'll see on the far left column the settlement items. where we're going to list all the items that we find in the paragraph on the previous page. And then we have 3 columns: the buyers, sellers, and trust account. We have the buyers column, which has a debit and credit column underneath it. We have the sellers, which has a debit and credit column underneath it. And then we have the trust account. And the trust account, I don't want you to confuse that with the trust account that the responsible broker is required to carry. This trust account is really the account that's sitting at the title company. And the funds that go into this account, this trust account, or the funds that come out of it, are either going in from or out from a third party that is not the buyer or seller. So if there are fees that the title company is charging, they're not the buyer, they're not the seller, and so their money is going to go into the trust account. A broker's commission. The seller pays the commission, but the money from that commission then is going to go into the trust account so it can get paid out. Same thing on an appraisal. An appraiser is not the buyer or seller, they're the third party, so their money is going to be found in that trust account. And if you have an accounting background, this may come a little bit easier to you, but the last thing I'd like to point out before we go back to our chapter 2 is that every column we see debits and credits for buyer, seller, and trust account. And if I have a $100 debit, let's say in the buyer's column, so I have a $100 buyer debit, I have to have a $100 credit somewhere else. Everything has to balance or cancel each other out, however you want to look at it. So if I have a $3,000 debit, I had to have a $3,000 credit. And we're going to create a little cheat sheet to help us through these story problems in a minute, and you'll see how all that plays out. So going back to the next page in chapter 2 for settlement statements, page 23, you'll see at the top prorations. Prorations is the, or prorating we could say, is the mathematical process that you're going to use to figure out an accrued item or a prepaid item, and it will tell you how much the buyer has to bring in or how much the seller has to bring in, or well, how much the buyer or seller is going to get. And that's all that proration is. It's a mathematical process. It has nothing to do with an accrued or prepaid other than we're going to use this mathematical process of proration to determine what that amount is. And so if we read in these paragraphs, it says the buyers and sellers usually will have some items that need to be prorated between them. The items will be loan interest, taxes, rents, utility bills, fuel oil, and LP gas, and there's other ones out there like homeowners association dues, propane tank, and other things like that. These expenses need to be divided fairly between the buyer and seller, and this process is called prorating. So prepaid items is the first one. Prepaid items, such as fuel oil, it's been paid by the seller, and the seller earning remains in the tank and will be there at closing, and the buyer's going to use it. Real estate taxes that are prepaid by the seller for the year, the buyer will be owning the real estate and will be responsible for taxes during that period of time. Those items will show up as a credit to the seller and debit to the buyer. So first off, let's take a little bit closer look at our prepaid items. So I know they mentioned fuel oil, but let's look at a propane tank, okay? Something that is a little bit more relative to us. Not a lot of people use fuel oil anymore. So let's look at this propane tank here. And so this propane tank was filled on January 1. And it's going to last the seller through the end of the year. And so when we do these prorations, we're going to have a timeline. And if you notice in your book, there's a timeline at the bottom of each worksheet that's in there. So you're more than welcome to use those timelines that you'll see on the settlement statement worksheets to help you with these prorations. So I'm just going to put some lines in here for our months, and we're just going to assume that this is June, and this is when we're closing. So the propane tank has been filled for the entire year. Now, we're going to close on it in June. There's still propane sitting in there. So let's say the propane tank is half full. And I know propane is a gas, so it's not going to look like that. But for this story example, that's how we're going to look at it. So the propane tank is still half full. Who's paid for this? The seller. So wouldn't it be fair then, and that's really what proration's, I guess how I look at it, is it's fairness. Wouldn't it be fair then that the buyer compensate the seller for what's left in that propane tank? That the buyer just doesn't move in and get to use up what's ever left? So that's how we're going to approach these prepaid items, is we're going to move forward on this scale, or on the timeline. Prepaids, we're always moving in that direction. So when we read these story problems and we have to do a proration, which I think it's inevitable in every one, you're going to see at least one, maybe two prorations you're going to have to do. The first thing is to go down to your timeline and mark off which months that you're closing in. So you got that right. And then you need to figure out, is the item that I'm looking at a prepaid or is it an accrued? And if you determine that it's a prepaid, then you know which direction to go on the timeline. And then it's some addition and subtraction and multiplication, or maybe division, and then you got your answer. That's the simplest approach. I see people that they have the basic understanding of how to do it, but when it comes time to actually putting it on paper, they don't take the time to figure out if it's a prepaid. And then what they're doing is they're counting these months instead of counting these months, and they're always getting the wrong answer. When if they just would stop and think about it, well, this is a prepaid. Okay, it's prepaid. So if it's prepaid, I'm going this way. Now, who's the one that's going to have to cough up the money here? The buyer. So that's going to be a buyer debit, and it's going to be a seller credit. Buyer debit, seller credit. So if we determine that this amount is $562.83, it's going to be in our settlement worksheet that we have, we're going to put $562.83 in the buyer's debit column, and then $562.83 in the seller's credit column. If I move on to accrued items, that's in the third paragraph there at the top of that page. Accrued items to be prorated, such as interest and arrears, real estate taxes due at the end of the year and are owed by the seller, but eventually paid for by the buyer, will be a debit to the seller and a credit to the buyer on the settlement closing statement. So what's more common in our real world is real estate taxes. Real estate taxes are paid in arrears in this area. And so if I'm paying right now my tax bill in March of 2007, it's actually paying for March of 2008 or 2006. It's paying for 2006 taxes. We're paying in them arrears. So if I draw out my timeline again, and I'm closing in June as well. So commonly, when you read through these story problems, you're going to see that it says that the taxes were paid in full last year. So taxes were paid in full up to the end of last year or through the first of this year, however they word it. But nothing's been paid here yet. So the seller has not paid any taxes for this calendar year, for 2013. So we're closing in June. This really, if you want to look at it, is the exact opposite scenario as the prepaid. So we're closing in June. Sellers haven't paid taxes. Or they have, but they just took care of last year's. So all these have not been paid yet. The buyer's going to move in here. And from here going forward, they're going to be occupying the property. They should be responsible for the taxes, but it's not fair that they have all these months of taxes where the seller lived in it and were not paid. So when we look at an accrued item, we're going to go backwards. When you see an item that's paid in arrears, it's another way of looking at it. That word arrears, you got a behind, right? Arrear. So you're going backwards or behind. So the sellers are going to have to get those caught up. That being said, it's going to be a debit to the seller and a credit to the buyer. Debit seller, credit buyer on those items that are paid in arrears or our accrued items when we're doing our prorations. So again, simply finding out when we're closing and if the item's going to be an accrued or prepaid item is going to help you immensely in determining the amount. So on this one, we determined that the taxes that need to be caught up are $1,285. So on our settlement worksheet, it's going to be $1,285 debit seller, $1,285 credit to the buyer. Continuing on this page, we have some rules for prorating. Most of these are for prorating in the real world, with the exception of number 2. Number 2 talks about how we're going to prorate for this workbook and then also for exam purposes. Unless it states otherwise, when we approach, if we read through number 2, when we approach our exams or workbook, we're going to have a 360-day year and a 30-day month. So if I have 30 days in a month, 12 months in a year, we get 360 days in a year. You can read 1, 3, 4, and 5 on your own. So using this blank settlement statement worksheet, we're going to create a cheat sheet. Now on the far right side, left side, like we have looked at before, we see our settlement items, and that's what I'm going to give you. Then I'll tell you who is the debit and who's the credit. And so what I've done on mine is I've simply wrote in all mine, and then I put X's in the blanks. I highlighted the blanks as well. You can use marker and black out the blanks if you want. You can circle the blanks, but there was, just to address some of the common confusion that happens with these cheat sheets before we get into it, is number 1, where I'm having you put the X's. So like for instance, our earnest money is a credit to the buyer and a debit to the trust. So you're going to put an X in the buyer's credit column and an X in the buyer's or in the trust debit column. Make sure that you know when you go to do your story problems, that those are the columns where that earnest money is going to go into. I had one student who did this, and when they put their X's in, they got all the X's in the right blanks, but then they thought, when they went back to it, that the X's were the blanks that the money was not supposed to go into, because they put an X there, and that subconsciously was telling them don't touch those blanks, and so now they were all messed up. Another thing that is even more common is when I give you all these settlement items, when you approach the story problems, a lot of times students will basically write out all the settlement items that I gave them on the cheat sheet. They'll write them in their blank settlement statement worksheet that correlates with the story problem. And then they'll look through the story problem to find all those settlement items, and then they rack their brain because they can't find them all. And so the cheat sheet is a guide. That's all it is. It's just going to help show you where these items go if you find them in the story problem. So don't use that guide, the cheat sheet, as a way that I have to have every one of these filled in for my worksheet when I do my story problem. That's not what it's meant for. It's meant that if I have, like, for instance, earnest money in my story problem, I can go to my cheat sheet and find out who's it a debit to and who is it a credit to. That's what we're creating. And so some of these you won't find in your story problem, and vice versa. There may be some items in the story problem that are not on the cheat sheet. I only have so many blanks for the cheat sheet, but fortunately, the ones that you may find that aren't here, they're going to be spelled out as far as who gets what. It's going to say that the seller is going to give the buyer $250 at closing for paint. So that's $250. It's coming out of the seller's pocket and it's going into the buyer's. So they're going to tell you how the money is going to be divvied out. And so I'm going to go through here and tell you how to get to the very bottom, where not the very, very bottom, but the bottom that tells us to total up all the debits and credits, and explain this on this cheat sheet. So if you want to start, I recommend using the pencil. You certainly can use a pen, but if you start writing exactly what I say, I actually have other things that I add into or squeeze into these lines, and so you may need to abbreviate. So you might want to use a pencil, and sometimes I don't get it. I don't get all my debits and credits right, or I mess up. So I want to make sure that you have the ability to erase. So our settlement items, we see number 1, that first blank, and these numbers on the side are just there as a reference, okay? These are in no particular order, these settlement items that I'm going to give you on this cheat sheet. So it's no particular order that you have to write these in when you complete your worksheet. I'm just giving them to you in an order that maybe makes sense to myself. So the first one, number 1, I'm going to put the broker's commission. So in that settlement item, for number 1, you write in broker's commission. And the reason why I'm putting that first is because that's actually the most common one that's left out. When students go through here and complete these, usually if they miss one or leave one out, it's the commission. So broker's commission is going to be a debit from who? Who would you think? Seller, right? The seller's paying the commission. Debit seller, and it's going to who? Who's getting the commission? The trust account. Yep, because the agents involved are getting paid, or the firms, and they're not the buyer or the seller, so it's going to be a debit seller, credit, trust. The next one is the new mortgage. This is the buyer's new mortgage. This is, we could look at it as the loan that the bank is borrowing to the buyer, the loan the bank, or that the buyer's borrowing. So the new mortgage, many times it's going to be referred to as the new mortgage, that is going to be a credit to the buyer and a debit to the trust. Credit buyer, debit trust. The old mortgage, this is typically the seller's old mortgage. This is what they still owe on it as far as what they owe the bank. That is going to be a debit seller credit trust. Seller's old mortgage is a debit seller credit trust. The next one, I have three different terms, but they're all going to be on the same line, and they're all going to be the same as far as a credit to the buyer and debit to the seller. And that is an assumed mortgage, contract for deed, or you can just write CFD, or owner financing. So assumed mortgage, contract for deed, owner financing. That's where the seller is going to basically pay, or play the role, I should say, play the role of the banker on behalf of the buyer. So that's a credit to the buyer, debit seller. Credit buyer, debit seller. Purchase price. Purchase price, this is the sale price of the property. That's a debit buyer, credit seller. Debit buyer, credit seller. And these may seem a little bit off. You're like, no, I think that should be the opposite. Or this one should be debit rather than credit. But when we go through and tally up our totals and do our subtraction, you'll see how it's necessary to have them in these columns for them to offset one another. So that's our purchase price, debit buyer, credit seller. Prepaid items, which we have looked at already in our propane tank example. Prepaid items. It's a debit to the buyer, credit to the seller. Debit buyer, credit seller. And then our accrued items are next. Accrued items, things like real estate taxes that are paid in arrears. Accrued items are going to be a credit to the buyer, debit to the seller. Credit buyer, debit seller. So accrued items are debit, seller, credit, buyer. Earnest money is next. Earnest money is the money that the buyer put in good faith in the purchase agreement. It's deposited. It's typically sitting with the listing broker. And then it's going to come back to the buyer at closing. And it's going to help to offset what the buyer has to bring into closing. So since it's coming out of the broker's trust account, or a third party we could say, or a party that is not the buyer seller, that's going to be a debit trust account, credit buyer. Debit trust account, credit buyer. Next we have rent or security deposits. Either way, they're going to be lumped in the same category. Rent or security deposits, you may see a story problem where somebody's buying an apartment building. So now all the security deposits that have been sitting in the trust account on behalf of the seller have to be transferred over to the buyer. So rent/security deposit is going to be a credit to the buyer and a debit from the seller. Credit buyer, debit seller. The seller's been holding all those security deposits, most likely in their own trust account. And so the seller needs to give that to the buyer. So as the tenants begin to vacate, the buyer has the new owner, the buyer, has their security deposits. Personal property. Personal property is the next one, and that's a debit, buyer, credit, seller. Personal property, debit, buyer, credit, seller. They're going to be buying some things from the seller, like at closing the buyer is going to receive the 55-inch plasma that the seller has in the basement, or the oak pool table in the game room. Loan fees, or we could say origination fees. Loan fees or origination fees. These are negotiable. And so you're going to have to read and find out who's paying it, okay? Because this could be a debit for the buyer, or it could be a debit for the seller, depending if the seller is going to pay for it on behalf of the buyer. So what you'll do is you'll check the buyer's debit and the seller's debit, because like I said, it could be either or they could be splitting them. And then it's going to be a credit to the trust account. So loan fees, they're negotiable. Deed preparation. Deed preparation is almost always a debit for the seller. They have to pay for the deed prep, and then it's going to be a credit for the trust account. The party that is charging them is not the buyer. It's a third party. It's a party that's outside of this transaction, or outside of the, well, I should say that's not a buyer or seller. So their money is going to be in that trust account. Transfer tax. This is another item that's typically a seller debit. Transfer tax is a debit, seller, credit, trust. Recording fees. These are typically charged to the buyer, so recording fees are going to be a debit to the buyer, a credit to the trust. Attorney fees. These are negotiable, just like those loan fees that we talked about earlier. So it could be a debit to the buyer, or it could be a debit to the seller. Again, you just have to read the question. So loan fees, or I'm sorry, the attorney fees are negotiable. And so you may see it as a debit buyer or a debit seller, and then it will be a credit to the trust. Survey fees. This is going to be almost always charged to the buyer. The buyer has to pay for the survey. So it's a debit buyer, and then the surveyor is not the buyer, and the surveyor is not the seller, so it's going to be a credit to the trust. Property insurance. This is another charge to the buyer. So it's a debit, buyer, credit, trust, property insurance. Next we have closing fees. And then the next line below that will be title insurance. I'm going to kind of talk about these both together, because if you remember our example from earlier in chapter 12, we talked about closing fees, service fees from the title company, and the title insurance. Those are usually split 50-50 between buyer and seller. And then it's going to be, so it'll be a debit buyer, debit seller, credit to the trust on both of those. But what I want to point out is that on the answer keys, for instance, you're going to see that let's say there's a $500 cost for title insurance, and that's going to be split 50-50 between buyer and seller. So when you go to the answer key for title insurance, it will say title insurance, and it'll just have one line. And so it'll be $250 debit for the buyer, $250 debit for the seller, and then a $500 credit in the trust. If you take those $250 and $250 and add them up, you'd have $500. And so that full line will balance out. What you can do, if you have enough lines, or you can make more lines if you wish, what you can do is you can have a separate line item for both. You can have title insurance buyer, so you have a $250 debit buyer, $250 credit trust, and then a title insurance seller, so you have $250 debit seller, $250 debit or credit trust. So on the answer key, they're going to just combine them on one line. You can certainly, by all means, do them on two separate lines. But that's going to be for title insurance and closing fees. So I wanted to kind of sandwich those together because, or you can put them on separate line items for the settlement items, but what I wanted to distinguish is that for your answer key, they may be put together, but you can certainly put them in separate line items if you wish. Mortgage insurance is the next one. Mortgage insurance. Mortgage insurance is also something that's negotiable, but typically you're going to see it as a debit to the buyer and a credit to the trust. Debit, buyer, credit, trust. That's mortgage insurance. And then finally, evidence of title. And you'll have to read the question as well, but this evidence of title is typically a debit for the seller and a credit to the trust. So the last two we had was mortgage insurance, which was a debit buyer, credit trust, and evidence of title, which is a debit seller credit trust. So now that we created our cheat sheet, there are items that are a little foreign to us. But if you look at the bottom of page 23, you'll start seeing some definitions or reasons why the accrued interest is where it goes, or the real estate taxes are where they're at. And if you keep reading on page 24 and 25, you'll see even more direction and understanding as to why the recording fees are what they are, transfer fee tax, title insurance, and so on. So it'll help to give you a better understanding of why these items go where they go. Because when you go to take your exams, you won't be able to take in a cheat sheet with you. You'll have to know where these go. The fortunate thing, though, when you do take the exam, is if you look on page 26 where this story problem is, it's not a long drawn-out problem like this. The actual exam is maybe about half of this in a couple paragraphs, and then you have to just simply figure it out from there. And you'll have scratch paper, so you can do that on there. On problem 102-4 that we'll get to later, there's an actual quiz that accompanies it. And that quiz is great for helping you to kind of see with the bird's eye view what the test will look like. Again, 102-4 is much, much longer than the actual test is, and I think there's 10 questions for the quiz. And so you can imagine about half of that. So probably 4 or 5 questions on the exam with half the length of the story problem. So before we start 102-1, let's go back to our worksheets. The real estate math worksheet, we're on page 3 now. And we're going to do some prorations before you get going on those. So looking at that third page in the real estate math handout, we read that top paragraph, and now we're going to do example number 1, which is actually done for you, but I'm going to walk you through it, and then I'll let you go on example 2, 3, and 4. So taxes on a property are $1,200. This is example number 1. They are paid in arrears. on December 31st, it should also say something to the fact that they're paid through to the end of December 31st. If the closing is set for May 15th, how much will the seller pay at closing for the property taxes? So when I do prorations, the first thing I do, again, because I like to keep it simple, is monthly taxes or the annual taxes are $1,200. And I need to figure out the monthly. So $1,200 for my annual taxes. I divide by 12, and you'll see that already done for you. That puts them at $100 per month. And really, from there, I just simply figure out where my closing date is, if it's a prepaid or an arrears, and then whatever that is, whatever the months are, I count them up and multiply times 100, and I got my answer. So we are closing on May 15th. So May 15th, we're closing. And is this going to be a prepaid or an accrued item? Very good. It's an accrued. The sellers have not paid it. They've just paid this last year's. They haven't paid this year's. So it's an accrued. And on an accrued, we're going backwards. So I have 1, 2, 3, 4.5 months. That's how I count them out. There's different ways you can count them out. You just do it half on the 15th. Don't add an extra day, because it's just a 30-day month. So if you close on the 16th, then you would, instead of figuring out how many months there are, I would figure out how many days there are and then count it out by that. So I would do 1, 2, 3, 4 months times 30 days each month, so that's 120 plus the 16 days, so that's 136 times whatever the daily amount is for taxes. Exactly. They will give you a date when your taxes have been paid and when they haven't. And so, like you said, in South Dakota, we pay taxes in October and April. Please erase that from your mind. This is not South Dakota. This is story problems out of a book. It has no bearing on South Dakota property tax law. They'll tell you what it is. You won't have to remember, well, in the real world, it's this and this. Forget all that, because it will mess you up 100% of the time. Well, and here's the thing. You're going to find a lot in most story problems in this book and in the workbook and even on the exam, they're going to bring in real estate taxes, and you're always going to have to prorate them. And again, proration is that mathematical process. And most of the time, when you look at the real estate taxes, it's not every time. Again, you always have to read the story problem. But most of the time, they've been paid in full through last year, and they just haven't been paid this year. So it's just like this scenario that we're doing on our first example. So you have to read it, and you'll see that, like we said, there's 4.5 months. So it's $100 per month times the 4.5 months. So we get $450, and that's going to be it. The tendency is to try and figure out, well, what about this? Just answer the question. Yep. So I'll let you go on example number 2 and 3 and 4. Okay, so example number 2. Pete is buying a home. Annual taxes of $1,080 are paid in advance on January 1. Annual water bill is $120 paid in arrears on December 31st. How much will Pete owe the seller for these expenses if closing takes place on July 15th? So let's first determine our closing. We have July. Closing is on July 15th. First thing I do is figure out what my monthly is. So my water bill is $120 divided by 12 is $10 per month. Tax is $1,080 divided by 12 is $90 per month. And I have two different items, water and taxes. Taxes are paid in advance. So they're a prepaid item. We're going to go forward with our taxes. Our arrears is the water bill. It says the annual water bill is $120 payable in arrears. So now that I got my colors straight, for my water bill, I have 1, 2, 3, 4, 5, 6.5 months. So I take that times 6.5 at $10 per month, and I get $65. I can count my months for my taxes, which the remaining months is 5.5. So if I take the $90 times the 5.5 months, I'm going to get $495. That looks a lot better. So the question is, how much is Pete going to owe for these expenses if closing takes place on July 15th? So I have $495. And when it comes to Pete, this is a prepaid item, right? The $495. Is that going to be a debit for Pete or a credit for Pete? A debit, because he has to reimburse the seller. So he has a $495 debit. The $65, this is one where the sellers haven't paid these months and they need to get them caught up. Is that going to be a debit or credit? Credit. So if he has to come up with $495, that's his debit, but he's getting a $65 credit. So when I subtract these, $495 minus the $65, I get $430. So example number 3, the closing takes place and the seller is delinquent, or we could say behind, $572 on their taxes. This would show on the settlement statement as credit to credit buyer, debit seller. Yep, the seller's going to have to get those caught up. Example number 4, Mr. Smith's property tax is $948 per year and is paid in advance semi-annually on January 1st and July 1st. He sold the property to Ms. Huff. Closing took place on August 1st, and the settlement statement would show what? So, property tax is $948 per year, and she pays it in advance, semi-annually, on January 1st and July 1st. So January and July, she makes a payment. And January covers this, and July covers that. And it's $948 per year. Take this and I divide it by 12 right off the bat so I can figure out my monthly, $79 per month, but I'm also going to take it and divide it by 2 because her payments are done semi-annually. So she makes 2 payments of $474. So here she cuts a check for $474, and here she cuts a check for $474. So we're closing on August 1st. So she has 1, 2, 3, 4, 5 months. So we have $79 per month times 5, and you get what? So we have a $395 credit to the seller, $395 debit buyer. Now, with these as well, please don't overthink this on who should be getting what. We determine it's an accrued item, and we know that, or a prepaid item, and we know that prepaid items is a debit to the buyer, credit to the seller. Sometimes I have seen where a student tries to argue, well, technically it should go to the trust because this person should be getting the money. Don't overthink it. $395 is going to be a prepaid, and it's debit, buyer, credit, seller. Now you can work on examples 5, 6, and 7, or the final page of the real estate math, and then we'll go through those together as well. Okay, so if we look at example number 5, we see that Beverly buyer purchases a house for $35,000. She deposits 10% on the offer and acquires a 75% loan. You'll see that I put in parentheses there that she puts 10% down as earnest money. And the reason why I have that is I'm trying to help you see what that 10% is. Because in the real world on the test, it'll say that she deposits 10% on the offer. They won't give you that parentheses that I gave you. When they say that, she deposits 10% on the offer, that's her earnest money. It's not her down payment. The lender charges her a 1% origination fee. How much will Miss Buyer need at closing? So we need to basically add up her costs, and so we know what she has to bring in to close. So the first thing that I did over here was take the down payment, or figure out the down payment, because we know she has to come up with 25% down. And I'm using the T formula. Again, there's other ways to do it. So when I take the 25% times the 35,000, because I'm multiplying when I'm going across, I get 8,750. That's her down payment. So that's one cost, and I wrote that over here. So far, Miss Buyer's costs are 8,750 for a down payment. The next thing it tells us is that the lender's charging her a 1% origination fee. And so here, I figured out my origination fee. Before I could multiply that times the 26,250, I had to figure out what the 26,250 is. And that's really what my loan amount is. That's what the origination fee is being charged on, is the loan amount. So I could do my T formula like I've done down here, where I do 75% of the 35,000, and I'd get 26,250. Or I already know that she's going to put down the 25%, which is 8,750. I could just subtract that off the $35,000 purchase price, and that gives me the 26,250. Either way, this is my loan amount, and it's a 1% origination fee based on the loan amount. So 1% of tells me I need to multiply, gives me $262.50, and I have that right here. So I have my down payment and my origination fee. When I add those two up, I get $9,012 and 50 cents. That's what she has to bring to closing. But there's one more step. Subtract the earnest money. Now, when you see your test, they'll have in A, B, C, or D, they'll have $9,1250 in there. And if you don't take it to the next step, you'll pick that one and move on, and you'll end up getting it wrong. Because there's one more thing in here that's going to help to offset that, which is the 35 or the 10% down payment, or not down payment, the 10% deposit, right? Or earnest money. So she has earnest money. That's 10%. It's 10% of what? Yep. Which gives us how much? So it's 10% of the $35,000 purchase price, which gives us $3,500. So that's a credit coming back to her. So if we subtract that $3,500 from the $9,1250, should get $5,512.50 or $5,512.50. Well, if I had to look at the 12% of the test, that's math for your state and national. Out of that 12%, I'd say you're going to have an equal number of 3 different levels of questions. So you'd have a third of that as easy questions, like we had at the beginning, figuring out commissions and those, just maybe 1 or 2 step type questions. They'll have probably another third that are medium type questions. This one is kind of like a medium, maybe a medium to hard, but the ones on the previous page, those are kind of medium questions. You have 3-4 steps to figure it out. And then you'll have another third that'll be pretty hard questions. You might only have 2 or 3 steps, but you really have to think it through. Right. I guess what I did is my approach was I looked at the math, and if it was a softball question like what's the commission off the sale price of this and that, I answered it, and then I moved on. So I'd at least read through it, but about 3/4 of them I just skipped over. And I said, forget it, I'm not going to do it. And then I would do the rest of the exam, then I'd come back and I'd do my math at the end. And then how I passed my math is I worked them back into the problem. I worked the answers back into the story problem. So example 6, we have a propane tank that is filled for the year. The cost to do so is $1,250. The home closes on June 23rd. How much is credited to the seller on the settlement statement? Now, if they just said that this propane tank is filled, the cost to do so, they didn't say filled for the year, they just said filled, or they just said the propane tank cost, or the cost for the propane is $1,250. If the home closes on June 23rd, how much is credited to the seller? Because they're saying credited to the seller, we know that's going to be a prepaid item. Because prepaids are always credits to the seller, debits to the buyer. But they're telling us that it's already filled for the entire year. So it's filled for the whole year, this propane tank. Now, it also amplifies that it's a prepaid because it says that it's a credit to the seller on the settlement statement. What if the home closes on June 23rd, how much is the seller going to get? So June 23rd is our closing. So what answer did you get? And I had 648.89. I used the shift 4. And so you didn't. Both of our answers are correct. And so you'll see a number close to that. And so you're not going to be off by, you're not going to have both our answers and have to pick them. So they're going to go easy on you that way. Let me show you how we did it. We just take, because we're closing on June 23rd, which is something we're going to have to calculate now to the day instead of like June 1st or July 1st. So we're going to divide this by 360 days for the year, which gives us $3.47 per day. And now we simply figure out how many days. We're going to go this way on our timeline because it's a prepaid item. That's the beauty of figuring out if it's a prepaid or accrued, because once we figure out which is which, we just go that direction on the timeline, count our days in this example, or months, and then we got it. So how many days? If July is the middle of the year, July to the end of the year is 180 days. So I could just say July to the end is 180. And then from June 23rd to the end of the month, if I have a 30-day month, is 7. So I have 187 days. And I take that times $3.47 per day. $648.89. And that's going to be a credit to who? Seller. Credit to the seller, debit to the buyer. So example 7, Brent finds his dream home. He and the seller agree on a price and set closing up for March 1st. Taxes have been paid through December of the previous year and are $1,350 per year. Taxes are paid annually. How will the credits and debits appear on the settlement statement? So taxes have been paid in full through the end of last year. Closing is March 1st. Taxes are a total of $1,350 per year. When we divide that by 12 to get our monthly, $112.50. Now we need to figure out which direction are we going. Is this an accrued or a prepaid? Accrued. So we're going this way. So how many months do we have? 2. We have all of January, all of February. That's 2 months. $112.50 times 2 months gives us $225. And that's a credit to who? Credit buyer, debit seller. And that's the way it'll appear on the settlement statement.